All right, let's say you're sizing up an income-generating property. What's the very first thing you check? I'm guessing it's the occupancy rate, right? I mean, a building that's 100% full seems like the absolute grand prize. But what if I told you that professional appraisers see a much, much deeper story? So let's just start with that big question right there. You drive by a building, you see that no vacancy sign lit up. Is it a perfect, risk-free investment? It's a really common assumption, but you know what? It's an assumption that can cost an investor a whole lot of money if they don't look just a little bit closer. You see, the people who determine a property's true value for a living, the appraisers, they know the real answer is, well, it's just never that simple. They have a specific method for looking past that perfect surface to find the real sustainable income a property can actually generate. And that's exactly what we're going to break down right now. This brings us to what I like to call the perfect income illusion. It's this gap, this space between what a property could earn in a perfect world and what it actually brings in when reality hits. I mean, think about it, right? On paper, if every single unit is rented out at full price, that income looks absolutely perfect. But in the real world, you've got tenants moving out, delays in finding new ones, people who don't pay on time, or maybe don't pay at all. The actual cash that hits the bank account is almost always lower than that perfect theoretical number. So how do the pros account for this gap? How do they make sense of it? Well, they use a critical tool called Vacancy and Collection Loss, or VCL for short. Let's decode exactly what that means. VCL it's basically a reality check built right into the numbers. It's an allowance that an appraiser subtracts from a property's absolute maximum potential income. Think of it as a built-in buffer that anticipates the inevitable bumps in the road of being a landlord, things like empty units and unpaid rent. And VCL really breaks down into two distinct parts. On one hand, you've got vacancy loss. That's the money you lose when a unit is just physically empty. Pretty straightforward. But then you have collection loss, which, let's be honest, is probably even more frustrating. That's the money you lose when a unit is occupied, but the tenant just isn't paying up. And believe it or not, it gets even more nuanced. You see, appraisers don't just see vacancy as one single thing. They see it in different shades, and each one tells a completely different story about the health of that property. Okay, this right here is a crucial distinction: physical versus economic vacancy. Physical is simple, right? It's the empty apartments you can literally see with your own eyes. But economic vacancy, that's the invisible income killer. It accounts for things like that unpaid rent we just talked about, or maybe giving a new tenant 2 months free just to get them to sign a lease. Your building could be 100% physically full, but still be hemorrhaging money from economic vacancy. We can also break down vacancy by why it's happening. Frictional vacancy is totally normal. It's the healthy turnover you expect as tenants come and go. It's just a cost of doing business. Structural vacancy, though, that's the one that should set off alarm bells. It points to serious long-term problems, like a bad location, an outdated building, or just way too much competition. It signals a much deeper issue. So now that we have all this knowledge, how do we actually start thinking like an appraiser? Well, it's all about shifting your perspective away from this exact moment in time and towards the long-term future. And this quote, man, it just sums up the whole philosophy perfectly. An appraisal isn't just a photo of the property today. It's more like a forecast. It's about how a typical, informed buyer would expect that property to perform over the long haul. One single good month or one bad month doesn't define its value. And that leads us to probably the most important distinction of all: actual versus stabilized vacancy. Actual vacancy is just what's happening today. Maybe you got lucky, you're 100% full. Great. But an appraiser uses a stabilized vacancy rate. That's based on what's normal for that type of property in that specific market over a long period of time. So even if you're full today, they will still deduct a stabilized vacancy rate because they know, and we know, that over the next 5 or 10 years, 100% occupancy just isn't sustainable. Okay, let's put all the pieces together. How do we get from that pie-in-the-sky potential income down to a realistic number that you can actually use for evaluation? It's a really clear, logical sequence. So it all starts with potential gross income. That's every unit rented at market rate, perfect world scenario. From there, you immediately subtract that crucial vacancy and collection loss. Then you add in any other income, from parking spaces or laundry machines, and that gets you to your effective gross income, or EGI. This is your realistic top line. Finally, you subtract all your operating expenses, and what's left over, that's the net operating income, or NOI. And that NOI, that is the golden number used to figure out what the property is truly worth. Now, let's make this real. I want to show you how a seemingly small percentage for VCL can have a massive impact on the final value. Let's run through a quick example. Okay, imagine a 20-unit building. On paper, its potential gross income is a cool 3.6 million pesos a year. Looks pretty good, right? But then the appraiser steps in. They analyze the market, they look at the competition, and they apply a stabilized VCL of 7%. And just like that, bam, over 250,000 pesos is wiped right off the top. That is the reality check in action. So after that deduction, we're looking at a much more realistic, effective gross income of just under 3.5 million. From there, of course, we have to subtract the expenses, the taxes, the maintenance, all the costs to run the place. That leaves us with a net operating income of about 2.27 million pesos. And that NOI is what determines the final value, 25.2 million pesos. Now, think about that for a second. That seemingly small 7% VCL deduction didn't just tweak the numbers, it directly reduced the property's valuation by millions. It's not just a tiny detail, it is absolutely foundational to the final price. So, what's the big takeaway from all of this? It's really about learning to think like a professional. You've got to look beyond that shiny surface and understand the huge difference between a physically full building and an economically performing one. And always, always use a long-term, stabilized vacancy rate that's supported by actual market data, because that's what truly determines the bottom line. And that really brings us to our final thought. The next time you see a property that's fully leased, you'll know that the smartest question to ask isn't just about its occupancy. The real question is about its effective income. And now, you know exactly how to find it.